Buffett regrets a $2 billion energy bet. He should come with us the next time we go digging for value. I am Allison Southwick, and I am here, as always, with Taylor Muckerman and Joel South, energy analyst here at the Motley Fool. Today we're going to get to the headlines, and then we're going to dig in a little deeper and talk about what to watch in Ukraine and Russia as you are watching everything unfold on CNN, on
As
your
an
TV.
investor in energy, what should you be paying attention to?
Exactly. So let's start off with the headlines. First, we're going to go to Reuters, where we have learned that drilling for oil and gas deposits outside North America has hit the highest level in 3 decades. This is led by exploration and production in the Middle East and Africa. So I guess we have to talk about what's going on outside the U.S.
Yeah, it's an unfortunate circumstance when we have to, but it's nice to know that we've been overshadowing such a huge drilling boom that really not many people even knew was going on. Granted, this number doesn't even account for Russia and China and a few other countries that don't disclose their drilling numbers to these agencies that are adding everything up. Baker Hughes, in this instance, that provides the rig count on a weekly and monthly basis. It's great to see that the world is getting back into this and drilling more. They're drilling in older conventional plays as well as offshore, which is really big in Africa right now.
So as we've talked about, kind of capital expenditures have peaked. I think we talked last week, we talked about Exxon, how they're pulling back on their spending as well. So if we're at the end of a surge in exploration and development, what does this mean? What now?
Well, right now, I think you saw all this money. Now you know where it was going. It was going into drilling, and typically drilling, takes place a little bit before production. So maybe you'll start to see some production numbers finally start to catch up to all this drilling that's apparently been going on for the last year or so. This doesn't really include national oil companies because you don't really have too much insight into their capital expenditures. So that really holds true in the Middle East, where you have all those countries like Iran bringing a lot of their wells back online, and Iraq drilling when they haven't drilled in a couple years just based on sanctions. So a lot of countries, A, either coming online, or B, countries finding new developments unconventionally that they can take advantage of.
All right, let's move on. We're going to head over to the Financial Post, where according to a new study, Canada's oil sands are more cost competitive than U.S. tight oil. We're talking about a break-even cost in the Permian of $81 a barrel.
Seems high.
Versus the Canadian Bakken, which is coming in at about $44 a barrel. This article points out that it's a misconception that tight oil is more cost-effective, and that this misconception is driving up the share prices of some U.S. companies. So,
well, yeah, I mean, if you look at it on a book value basis, companies like EOG are trading more at a higher level. But if you look at it too, if you look at the Eagle Ford, the break even in the plays that they're in is significantly lower. They're not looking into what the shell actually is. Every shell is different. Some of it's natural gas, some of it's liquids, some of it's oil. So when you compare some of these break even numbers, I don't really gauge that so much on, they have the Eagle Ford at a break even about $63. That's pretty high, especially when a number of their plays you can get it at $20. And then also if you look at the break evens for the Canadian oil sands, if you look at new projects in the mining, which is still a significant development or way to develop oil, the new projects that are coming online are still at a break even that are around $100. And then you also have to look at the margins. Western Canadian Select, which is the benchmark of the oil sands, is trading at a $24 discount to what you get for WTI. So if you're drilling in the Eagle Ford and the Permian Basin, you're getting a lot more. You're getting that $103 currently for WTI oil, and you're transporting it pretty close to the source. So you don't have that fee, where the Canadian oil sands, cheaper oil, plus they got to put it on rail, which is more expensive, and bring it into town.
Now, the study came out from Scotiabank, as in Nova Scotia.
Sure.
So it sounds like I should be pretty skeptical of the numbers here, or I don't know.
Yeah, I definitely think so. These numbers look at, I think they're kind of pinpointing some of the plays that have the best economics. And just looking at the Permian Basin, you can look at a number of companies in there like ConocoPhillips, and their break-even price is significantly lower than that $81. From what I've seen, the $81 is pretty much the high mark. So I'm not really jumping into a lot of these numbers, and also their in situ, which is the steam-assisted gravity extraction in the Canadian oil sands. at $63 is very low. I've seen estimates in a number of studies that are significantly higher than that, also push it up towards the marginal cost barrel over $100. So I'm pretty skeptical with some of these numbers I'm seeing here.
All right, so don't change your investing thesis based on these numbers.
No, don't get rid of some of the United States players that might look more expensive because of these numbers.
All right, let's move on to the Associated Press, where Buffett's annual letter is out. Warren Buffett, that is, of
Warren
course.
Buffett,
and
right,
he's making the media rounds. He's saying a few things that will be of interest to energy investors, so let's pull those out. First one, he is not worried about the escalating situation between Ukraine and Russia. Not necessarily a big surprise considering such a bottoms-up investor that he is, though.
Yeah, he's the guy out there looking at companies in particular. He's buying the business, not the macroeconomic news. And he's basically talking about, hey, if your country isn't doing business in the Ukraine, or if it's less than 1% of its overall revenues, what do you even care about the situation? And I tend to look at that same viewpoint. So he's still bullish on the U.S. regardless of what happens. Obviously, if escalation and we get into a war in that area, but right now, the current situation, he's not too worried.
All right, the number two thing Buffett's been talking about is he owns BNSF Railroad, and he also owns a manufacturer of tank cars.
Right.
But despite that, he supports the Keystone Pipeline, and he doesn't think that the pipeline is going to significantly reduce oil transportation by rail. Do you believe him?
I tend to. I mean, they're talking about.
It's hard to,
yeah,
it's
I
hard
mean,
to be like,
I'm
no.
not going to come out and bash his optimism here, but with all the oil that's still under the ground and ready to be mined in Canada, those companies are waiting for some more takeaway capacity. So should it come online, they're likely to boost production to make up for that shortfall. And you're talking about 830,000 barrels per day with this Keystone XL pipeline that TransCanada has wanted to build for the last 5 or 6 years. Obama said maybe in the next couple months. I think that's an early April Fool's joke. He said that multiple times now. So with this, it adds some strength to BNSF. And Buffett is Berkshire owns the whole thing. They've slowly bought pieces, and then last year, the year before, swallowed it up whole. And it's been very, very well for them because of this crude oil transport. It's up over 400% since 2011 as an industry, not just for BNSF, but the industry carloads of oil up 400% in just 2 years. So that's a huge business, and I look forward to continue.
There's enough oil for everyone up there, huh?
Thankfully.
You're like, yep, all right.
More expensive than they think, but it is there.
There is there. If people need it, they'll move it.
That's right.
All right, last story we're going to look at is Fuel Fix, and we're staying on the topic of Warren Buffett because he says that Energy Future Holdings will most certainly file for bankruptcy this year unless natural gas prices surge. The company is weighed down by more than $41 billion in debt.
Man, bringing the hammer on this company.
Right? Berkshire Hathaway has eaten already $873 million in pre-tax losses, which I will point out isn't as much as he's going to lose when I win his $1 billion March Madness
put him out of
bracket
business.
challenge.
Watch out, Berkshire. Watch out, Berkshire.
I'm coming for you. My bracket.
Studying college basketball all
These kids
year.
are screwed.
I know, it's gonna. My bracket is gonna be.
Wichita State to the Final Four again.
I'll get it. I'll nail it.
Yeah, I mean, going back to the story, I think it is interesting, and this is one that Warren Buffett in his letter on Steady released on Saturday said that he didn't check in with Charlie Munger on, and he said that was a big mistake. And what he was doing is this is a utility that had a lot of regulated business and then also had the unregulated side, and that's really what kind of hurt them. Obviously, he got out of it last year, so that's the loss that they're having. But overall, this is pretty small, especially when you see so much purchasing that Berkshire has done through Mid-American Energy and the utility and energy side overall.
Right now, they actually bought through Mid-American Holdings. They bought Nevada Energy last year. How different is that deal? Because Energy Future Holdings, they were Texas, right? So how is this different?
So I think this is one of the deals that I think shows why Buffett is who he is and Berkshire has been so successful. This is a regulated utility. They control or service about 88% of Nevada. But if you look at what they're doing right now, they originally put in announced that they had intentions to go into the California ISO, which is basically being able to sell power into California. And what he's doing through this is he's connecting to the Northwest and getting a lot of the hydropower. He's moving it through Nevada into California, and he's also tying in a lot of the solar projects that he has in Nevada as well. So when prices spike in California, and with California having a renewable portfolio standard that's supposed to be 33% of all energy produced in the state by 2020, they're going to need a lot of this renewable energy. He's going to be able to supply it, and he's building out so many of the SunPower plants, utility scale plants down there, having the Northwest too and all tied in. this is not only making all the regulated side, when the prices spike, this investment's really going to pay off. So, and also in his letter, he's saying this is something that it's going to cover all the maturities through the normal business, and then everything else is going to be on top of that, where 20 to 50 to even 100 years down the line, this is still going to be a solid business returning good rates of return for him.
And so do we know if he ran it by Charlie Munger?
This one, yes, he did.
All right, there you go. That covers it for the headlines.
Investment then.
Right. Now we did talk about that. Like I said, covers it for the headlines. Now we're going to talk about Ukraine and Russia. Buffett said, like we already mentioned, he isn't worried. What?
A lot of Buffett.
There's a lot of Buffett. We're big on Buffett.
I'm telling you, he's going to be an energy company rather than insurance in the next couple of years.
That's
why.
20 years down the line, he's going to be a big energy guy.
That's right.
20 years down the line. Let's hope he's still
still has some energy.
Yeah. So, like we said, Buffett isn't worried about for his investments between Ukraine and Russia, but that doesn't mean investors shouldn't keep an eye on it. So, what are you watching as the story unfolds?
Well, I definitely think it's important for us to focus on it because Russia is so heavily reliant on agriculture, mining, and oil. But I don't think it's going to necessarily affect the markets as much as it would a few years ago. You saw oil prices only up a couple percentage points yesterday on Russia invading another country, and the same country where its pipelines flow through to control about 30% of European Union's natural gas consumption. So this is a big deal, and I think what it's really going to start to change the focus on is our export policies, because our allies are now struggling or could potentially struggle if Russia decides to cut this flow off to the European Union. They're going to need that natural gas from somewhere because they aren't currently fracking at any sort of meaningful level to produce their own natural gas. So I think you're going to see some maybe the next 2 to 3 applications to export natural gas to non-free trade agreement countries. I think you could see those maybe come through in a bit more expedited fashion.
Yeah, I agree. I mean, if you look at everything that Vladimir Putin does, he's basically, his policy is a zero-sum game. He's really going after kind of the war games mentality. So you're going to see companies or countries go and try to find different sources, just like you mentioned with natural gas. A lot of pipelines do not directly go through the Ukraine like they were 6 years ago. Only about 30% of it does. So you'll see people try to go away from that. And you're going to see, I think, Vladimir Putin do some more of these moves because right now about 60% of their GDP is based off of the energy sector, and their trade balance is basically geared off of that oil and gas. And if these prices don't stay high, that's really going to affect his country because the manufacturing base is not there. So if you see prices start dipping, they're even talking about that Russia, to maintain their status quo right now, they're going to need $100 oil. So if you see prices start dropping, who knows what his next move is going to be. With his mentality and his history, this could be a really interesting move. However, mutually assured destruction with Russia, because if they cut off the ties, they're taking away a lot of their GDP as well. So you're going to have to see some good negotiations. And, the European Union, I think, has a stronger arm than they're actually giving right now.
All right, well.
Also, a couple other statistics to kind of add focus to the energy sector. You look at Ukraine, big economy, but the top 50 people in that country wealth-wise control 46% of the country's wealth. 50 people. So you're not really worried about all this other spending drying up because they're not going out and shopping at all these stores. They're distributing their wealth internationally. Same thing for Russia. It's not 46%, but the top 50 control a pretty significant amount of wealth. So you're really looking at their exports as what's driving the economies here. So I don't think the retail sectors or consumer goods or anything like that really has much to worry about with this. But energy and agriculture for sure, because you saw wheat prices spike even more so than oil did.
All right, we'll keep checking in on this as it
hopefully
evolves.
It doesn't take too long to fix the situation, but we'll cover it.
Yeah, right. It's frightening what's going on over there. I'm glad I live in America.
Yeah, thank God.
There's a lot of countries.
Rule of law.
I love America and I love other countries too. So, all right, that's going to do it for today. If you're looking for more energy investing analysis, you want to follow us on Twitter at TMF Energy. You can also send us your questions to energy@fool.com. For Taylor and Joel, I'm Allison. Thanks for watching.